Hi, I'm Adam with the Walker team. And if you're thinking about selling your home here in Silicon Valley, one of the biggest questions I get is, what are the tax implications? Let's break it down so you know exactly what to expect and how to maximize your profit. My first caveat, I'm not an accountant, so be sure to verify all of this with a professional. So up first, capital gains tax. Here are the basics. When you sell your home for more than you paid, the profit is called capital gain. Here in California, you'll face both federal and state taxes on that gain unless you qualify for an exclusion. Federal capital gains tax can range from 0 to 20% depending on your income and how long you've owned the home. California treats capital gains as regular income with some rates from 1% up to 13.3%, some of the highest in the country. The $250,000, $500,000 exclusion, your biggest tax break. Now here's the good news. If you've lived in your home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of profit if you're single, or $500,000 if you're married and filing jointly. To qualify, you must own your home for at least 2 of the last 5 years, use it as your primary residence for at least 2 of those years, and not have claimed this exclusion on another home in the past 2 years. If you meet these requirements, that chunk of your profit is tax-free. Anything above that exclusion is taxable. Now, here's why that matters here in Silicon Valley. Silicon Valley home prices have soared. The median seller gain here often exceeds the $500,000 exclusion, meaning many sellers will face taxes on at least a portion of their profit. For example, the median gain in some parts of Silicon Valley is now over $575,000. Now, how to minimize your taxable gain? Don't leave any money on the table. Here's how you can reduce your taxable capital gain. Keep records of all major home improvements, new roof, kitchen remodels, landscaping, etc. These costs add to your home's cost basis, reducing your gain. Include eligible closing costs from when you bought the home. Calculate your capital gain. Capital gain equals the sales price minus the purchase price plus improvements plus your closing costs. If you're over that exclusion limit, only the excess is taxed. Now, reporting and paying taxes. If your gain exceeds the exclusion, you'll need to report it on your federal and state tax returns. Use IRS Form 1040, Schedule D, and California Schedule D 540 for this purpose. Now, here's some special situations. If you don't meet all the requirements for the exclusion, you might still qualify for a partial exclusion due to job relocation, health issues, or unforeseen circumstances. Here are my final thoughts. Selling a home in Silicon Valley can be incredibly profitable, but the tax implications are real, especially as home values continue to rise and the exclusion amounts remain unchanged. With careful planning and the right documentation, you can keep more of your hard-earned equity. If you have questions about this or your specific situation, reach out. I'm Adam with the Walker team, here to educate and navigate. I'll see you on the next video.